$216.35. That is how much more workers above 85,000 are sending to CPP in 2026 than they did last year. The rate did not change, 5.95%, same as 2025. What changed is the ceiling. Ottawa raised it, quietly, no announcement, and for anyone above that income threshold, the higher ceiling is already on every paycheck right now. Nobody told you this. Now you know. If you are in Quebec, your contributions go to the QPP with different rates and ceilings. Everything today covers CPP, the other 9 provinces and 3 territories. 3 things you are going to understand by the end of this. Why a specific group of earners is paying more into CPP right now without any rate change. There is a date mid-year when your CPP deductions stop entirely, and what that means for your cash flow. And there is a bill in Parliament promising a rate cut next year. I need to tell you something about that bill before you build any plan around it. First, we separate the rate from the ceiling. 2 different numbers. The ceiling is the one that moved. Then, the second CPP tier most workers do not know exists and how it affects earners above the threshold. Third, the ceiling stop, the date mid-year when your deductions shut off entirely. And fourth, the bill in Parliament right now, and why you cannot bank on it yet. Here is the first thing, and it is the piece most people missed. The CPP employee contribution rate is 5.95%. It was 5.95% in 2025. It is 5.95% in 2026. The rate did not change. The headlines were not lying. They were just being technically accurate about the wrong number. What changed is the ceiling. CPP contributions are calculated on your earnings between the basic exemption and the year's maximum pensionable earnings, which the CRA calls the YMPE. In 2025, the YMPE was $71,300. In 2026, it moved to $74,600, an increase of $3,300 at the top end of the calculation band. So the math on your CPP1 maximum now looks like this. You take the YMPE of $74,600, subtract the basic exemption of $3,500, that gives you a pensionable earnings band of $71,100. Multiply by 5.95%, and you get $4,230.45. In 2025, the same calculation produced $4,034.10. The year-over-year CPP1 increase, $196.35. If your income sits below $74,600 this year, your CPP1 calculation did not change. This ceiling movement only catches workers whose earnings clear the YMPE. 2 people, same $80,000 Ontario income, same employer, both above the ceiling. Sandra reads the headlines. Rate did not change, she thinks. She does not adjust anything. David digs deeper. He finds the YMPE moved. He understands the ceiling is the number that matters, not the rate. That is just the first tier. There is a second CPP layer sitting on top of it that most Canadian workers have never seen on a pay stub, and it adds another number to the total we have not counted yet. Then there is the layer most people miss entirely, the second piece. In 2024, Ottawa introduced a second CPP tier, CPP 2. Most workers do not know it exists because it only shows up on earnings above the CPP 1 ceiling. The upper ceiling is the year's additional maximum pensionable earnings, the YAMPE. In 2026, the YAMPE is $85,000. The CPP 2 rate is 4%. It applies only on the band between $74,600 and $85,000. Mark is 57, lives in Ontario, earns $90,000 gross. He is above both ceilings. In 2025, his CPP1 was $4,034.10. His CPP2 was $396. 4% on the band from $71,300 to $81,200 which is the 2025 YAMPE. Total 2025 CPP, $4,430.10. In 2026, his CPP1 is $4,230.45. His CPP2 is $416, 4% on the band from $74,600 to $85,000. Total 2026 CPP, $4,646.45. Year-over-year increase for Mark, $216.35. That is the number for workers above $85,000. Both ceilings moved. If your income sits between the two ceilings, above $74,600 but below $85,000, your increase is smaller because the CPP2 band also narrows as the YMPE rises. But if you clear both ceilings, the full $216.35 is on every paycheck. If you run your own business, both numbers double. In 2026, a self-employed Canadian above both ceilings pays $9,292.90 in total CPP. And if you are between 60 and 64 and still working, there is no opt-out. Contributions are mandatory. That math took me 3 days to verify. If it saved you even 10 minutes, hit like so this reaches the next person. There is a point mid-year when that annual number hits its ceiling and your paycheck changes. That is where we go next. Third on the list is the ceiling stop, and it surprises almost everyone. Because CPP contributions are calculated on an annual maximum, once you have paid the full year's amount, your employer stops deducting. For Mark, at $90,000, his combined CPP maximum for 2026 is $4,646.45. The point in the year when he hits that ceiling depends on his income structure, his payroll schedule, and whether he receives any variable pay. Once he hits it, the deductions stop for the rest of the calendar year. What does that look like on your paycheck? Check your most recent pay stub. Find the line for your current CPP deduction for the period. That exact amount is what stops coming off when you reach the annual cap. Every earner's number is different because it is based on their actual pay and income structure, not an average. Sandra does not plan for it. When the deductions stop, the money shows up and she spends it before she thinks about where it should go. David already knows it is coming. He has decided in advance what that surplus does. One note before the CPT 30 math. This is a decision worth a conversation with your accountant. The stakes depend on your health, your income, and how long you plan to work. If you are between the ages of 65 and 70 and are already receiving your CPP retirement pension, it is called the CPT 30 election. Filing a CPT 30 form with your employer stops CPP contributions entirely. Your employer stops matching too. More take-home immediately. But here is what you give up. Every year of CPP contributions after 65 generates a post-retirement benefit, a PRB. In 2026, the maximum new PRB at 65 is $54.69 per month for life. Stop contributing and you stop earning new PRBs. You know the mid-year stop now, and you know the increase for earners above both ceilings, but there is a bill in Parliament promising to cut the rate next year. I need to tell you something about that bill before you build any plan around it. The fourth and final piece is the one getting the most headlines and the most important to get right. The Federal Spring Economic Update, tabled on April 28, 2026, proposed reducing the base CPP contribution rate. The current employee rate is 5.95%. The bill proposes to reduce the base component of that rate by 0.2%. The total effective employee rate would drop from 5.95 to 5.75% if it passes. If that passes before year-end, a worker earning around $70,000 would save approximately $133 in 2027. Here is what you need to know. As of May 6, 2026, Bill C-30 has received first reading only. It has not passed second reading. It has not gone to committee. It has not received royal assent. It is not law. A proposed rate cut is not the same as an enacted one. The increase you are paying right now is based on current law. The saving is based on a bill that has not passed. Tax professionals consistently advise planning around enacted rates, not proposed ones. Use the 2026 figures. Treat Bill C-30 as upside if it passes. You are paying more into CPP in 2026 than you paid in 2025. The bill that promises to reverse some of that would save a worker at $70,000 approximately $133 once it passes. The gap right now is real. The saving is not yet. And if it does pass, the effective date is January 1st, 2027, not this year. Plan for the rates that are law. That is where the math lands on current law. Now, there is one decision left. What David does with that bi-weekly surplus when the ceiling stop hits. This video is brought to you in partnership with WealthSimple Trade. I receive compensation for referrals through the link in the description. Here is the concept this connects to. When Mark's CPP deductions stop for the year, every paycheck from that point carries back the exact amount that was going to CPP each period. Whatever that line on your pay stub shows right now, that is what stops coming off. For the rest of the calendar year, that money stays in your pocket. The question David asked is the right one. Not whether this happened, but whether that money has somewhere to go before year end. WealthSimple Trade is where he put it. Commission-free trades, registered account support, no account minimum. It does not calculate your CPP benefit or tell you when to take it. It does not manage your portfolio or auto-rebalance. What it does is give that ceiling stop surplus a place to compound while you figure the rest out. If David is redirecting 2 or 3 ceiling stop paychecks into his TFSA before December 31st, 2 things need to be true. The account needs to be open. He needs to know how much contribution room he has left. Both of those are things you confirm before the money arrives, not after it does. The link is in the description. Whether redirecting your CPP ceiling stop surplus into a registered account makes sense for your situation is a decision only you can make. If your income crosses the CPP threshold, the moment your deductions stop for the year is your planning window. When it arrives, it is not a windfall. It is a recurring opportunity, and the sooner you plan for it, the further it goes. Subscribe so you do not miss the videos that cover those decisions. Before this video leaves your screen, one practical item. Find out which month your CPP deductions stop this year. Look at your most recent pay stub. Find 2 numbers, your year-to-date CPP total and your per-period CPP deduction. When the year-to-date total reaches the annual maximum we just calculated, the deductions stop. The per-period amount is your planning number. That is exactly what bounces back to your paycheck from that point forward. Pre-retirees who have been paying into CPP for decades rarely know this date in advance. Now you do. There is a video already on this channel that addresses the next question: where that CPP surplus money should land inside your registered accounts. It is called TFSA versus RRSP, the banker's secret mistake. The decision most Canadians get wrong is not which account to open. It is which account to fill first, and in what year. Getting that sequence wrong compounds against you for a decade or more. The money freed up by your ceiling stop is real money. Where it lands inside your registered accounts determines how hard it works for the rest of your retirement. That is what the next video covers. Watch it next. I'm not your accountant. Do your own homework. Thanks for watching.